Hello, this is Domenico with Easynomics, and we're going to continue our discussion of price controls. We're going to look at price floors, which is a minimum price. And we're going to use the example of commodity markets to again illustrate this. Looking at the commodity market of wheat, we can see that it's priced at, it's priced here at $231.75 per metric ton. But if we look at a 5-year time span, we can see that the price of wheat is very volatile. All right, trading at $181, rising to $192, then collapsing again to $184, rising to $200, collapsing again, etc. So to see prices rise and fall so dramatically over a short period of time, we know that primary commodity markets have both an inelastic demand and supply curve, which explains that volatility. That any shift in demand or supply leads to a greater change in price than in quantity. And for a farmer that's a price taker, that's very unsettling to see prices rise and fall, because when you bring your wheat, in this case, to market, perhaps the price that it's selling at doesn't cover your costs and you have to sell at a loss. That's why governments intervene to support farmers to provide them a guaranteed price, a minimum price, so that they can at least cover their costs, continue to produce, and that also provides food security for the nation. So we're looking at minimum support prices in India, and we can see that in India, they provide price floors for paddy, wheat, maize, barley, etc. We're going to use the example of wheat. Okay. So again, just for a little bit of review regarding elasticity, we know that in the commodity market, such as wheat, that the price elasticity of demand is less than 1, since, let's say, cereal producing companies and bread producing companies, wheat is the key input, so there's no substitute, so it's inelastic. In terms of supply, for farmers, it takes time to grow wheat, thus it's inelastic. And we're going to remember that when we have an inelastic demand supply curve, that the percent change in price will be greater than the percent change in quantity supplied and demanded, thus providing a reason for the government to intervene to provide a stable price for farmers. In the free market, without the government intervention, we know that where supply equals demand, where S1 equals D1, it provides an equilibrium price at PE with an equilibrium quantity at QE, right? That's where quantity supplied equals quantity demanded. And we know that the consumer and producer surplus is at maximum because at point A, marginal cost equals marginal benefit. It is allocatively efficient, right? Just to refresh our memory, the consumer surplus is the area below the demand curve up to the free market price. All right, you can draw that a little bit better. And the producer surplus is the area above our cost of production up to the free market equilibrium price. Just a reminder of what we mean by consumer and producer surplus. Okay. Now let's look at the government intervention. So the Indian government intervenes and provides a minimum price or price floor. Now let's say it's established right here, right above the free market price. So it's a binding price floor. And we'll call that PF for price floor. Now what happens when that is set? Due to the law of supply, because the price is rising, the quantity supplied increases along their supply curve. There's an incentive there for farmers to increase their production up to that price floor price. Thus, we see the quantity supplied increasing from QE to QS. But the higher price reduces the quantity demanded according to the law of demand. So the quantity demanded decreases along the demand curve up to this point, QS to QD. Okay? So since quantity supplied is greater than, I'll just make a note, since quantity supplied is greater than the quantity demanded, we have excess supply. We have surplus. Okay. Since the quantity supplied is greater than the quantity demanded, we have excess supply. Okay. Now, who is going to consume that excess supply? Farmers are producing way more than what is desired by consumers. Well, we're going to assume that the government steps in and consumes the excess. So we're going to draw an additional demand curve right here. We'll draw right here, we'll call it D2. And so that will be D2, which is equal to D1 plus the government purchase of the excess. All right, so we're going to label that as such. And we can also label this point here B, illustrating the increased quantity demanded, and C, the decreased quantity supplied. Now we need to label some areas to illustrate the changes in consumer and producer surplus, the generation of a welfare loss, and so on. So we'll call this area A, B, C, D, and E. In addition, we're going to label this area F, and we'll go ahead G, H, and I. You can label this as you want, but we'll label it like this: A, B, C, D, E, F, G, H, and I. Now notice that when the quantity supplied increases up to point B, we can highlight that at point B, the marginal cost is greater than the marginal benefit, right? So at PF, at price floor, since the quantity supply is greater than the quantity demanded, we can note that at quantity supplied, the marginal cost of production is greater than the marginal benefit, which means that there's an over allocation of resources to the production and consumption of wheat versus what is desired by society. And that excess is thus consumed by the government. Right? This is an important point because this is going to highlight that we have a welfare loss in this government intervention. All right. Okay, so that's how we would graph this. And then we need to evaluate the impact on stakeholders. First stakeholder that we're going to take a look at is the consumer. Right? With the government intervention, the consumer is worse off. Why? Because the price has risen from PE to PF. Thus, the quantity demanded falls from QE to QD. That would mean that the consumer surplus has decreased. Consumer surplus has decreased because before it was areas A plus B plus C, and now it is area A. Right? So since areas A, B, and C were greater than area A, consumers are worse off because they have less consumer surplus than before. Right? Just to illustrate that, before the intervention, consumer surplus was this area in the free market. But then after, it becomes just this area. Right? Only these consumers consuming at a higher price of PF. Thus, there's reduced consumer surplus or savings. So consumers are worse off as a result. Okay. Now let's look at the next stakeholder. Let's look at producers. Number 2. Producers are better off. All right. We can first talk about how the price received by the producer has gone up. It's gone up from PE to PF. And thus, we can talk about how total revenue has improved. Total revenue before, total revenue 1, was equal to PE times QE. But then it increases to total revenue 2, which is equal to price at price floor multiplied by the increased quantity supplied at QS. So total revenue 2 is greater than total revenue 1. So producers are generating more money. How do we see that? Again, let's see that originally the total revenue was this rectangular area. And then it increases as a result of the price floor to this entire area. So there's vastly much more total revenue for the producers. So they are better off. What about the producer surplus? Let's take a few notes about that. Producer surplus also increases. Producer surplus, right? Before the price floor, it was equal to areas, let's put D plus E. But then after the price ceiling, it then is equal to areas B, C, F, D, and E. So we'll say it's B plus C plus D plus E plus F. So since this is greater than DE, right, producer surplus has increased, again highlighting that producers are better off. Okay, let's just highlight that again. That originally producer surplus was this triangular area, right? Area is D plus E, but then it changes to this area, right? Vastly more producer surplus due to that increase in the quantity supplied. So producers gain this area of F. In addition, they take B and C, which was originally belonging to the consumers. Next, let's look at the government. The government is going to be worse off because they're going to have to use tax revenue and spend it on buying the excess supply, which creates an opportunity cost for the government because they could have used that tax revenue to on something else, provide some other public good or service for society. So the government is worse off, right? Because they have to buy the excess supply, and the value of that excess supply is this rectangular area. Right? The government's going to buy all of this. Consumers are only consuming this, and then they stop at the quantity demanded. So the excess between QS and QD is what is being consumed by the government. All right, so the government will have to purchase an amount as such. So the government purchase is equal to areas C plus E plus F plus G plus H plus I, which would be equal to the price floor multiplied by the amount that's being purchased, or quantity supplied minus quantity demanded. So that amount of tax revenue being spent, this price multiplied by this quantity provides us the surface area of this rectangle, and that creates an opportunity cost. The government could have used that tax revenue to provide some other good or service for society. Okay, great. Next, we can look at workers. Next is workers. They're better off because farmers can employ more factors of production like labor. More labor is employed as a result of the quantity being supplied increasing from QE to QS. All right, so workers are better off. Next, let's look at allocative efficiency. Okay. This outcome is allocatively inefficient. We see that at quantity supplied, at QS, the marginal cost of production is greater than the marginal benefit, which we see right here. Okay, so there is an overallocation of resources to the production and consumption of wheat versus what is desired by society. So what does that welfare loss look like? This creates a welfare loss which is equal to areas C plus E plus G plus H plus I. Okay? C, E, G, H, I, which is this area here. This is what society loses, all the resources being allocated to too much wheat. Why isn't F included, right? F is the additional surplus that goes to the producers. Remember that producers gain this area here. So with all of that government spending on buying the excess supply, it increases the producer surplus. And it generates this additional surplus of F, which does benefit the farmers. But it creates this welfare loss, right? It creates this area of G, H, and I. It also includes C and E. Now, why is C and E included? Because we would get area C and E in the free market anyway. If we would get it for free in the free market. So the government is buying the excess supply to generate C and E, which we would get in any case in the free market. So it's a waste of resources for the government to increase demand to generate C and E again when we would get it in the free market. So of all of this purchased by the government, the only real additional benefit is area F. And now I can go ahead and analyze this and evaluate this as we would for a paper exam. As can be seen, we have a graph illustrating the market for wheat in India. On the x-axis, we're measuring quantity. On the y-axis, we're measuring price. We have two downward sloping demand curves in accordance to law of demand labeled D1 and D2. D1 is equal to marginal benefit, and D2 is equal to D1 plus the government purchase of wheat. And we have an upward sloping supply curve labeled S1 equal to the marginal costs of production. Where S1 equals D1, it provides a free market equilibrium price at PE with quantity supply and demand at QE. Because the government is concerned that the volatility of price within the wheat commodity market may cause farmers to operate at a loss, they intervene and provide a price floor at PF, which is a perfectly elastic curve as we see here. That increases the quantity supplied from QE to QS at point B and decreases the quantity demanded from QE to QD. All right. We notice that with the price floor, the quantity supplied is greater than the quantity demanded, which creates excess supply. And we notice that at quantity supplied, the marginal costs of production are greater than marginal benefit. Thus, there's an overallocation of resources to the production and consumption of wheat. So that would be our analysis. Here is our evaluation. Let's evaluate the impact of the government intervention, in the case of price floors, on stakeholders. First, let's look at consumers. Consumers with the price floor are worse off. Originally, they had a consumer surplus of areas A plus B plus C. But because the price has risen from PE to PF, consumer surplus has been reduced just to area A. What about producer surplus, or producers? Producers are clearly better off. Before, they had a producer surplus area of areas D plus E. In addition, their total revenue was PE times QE. As a result of their ability to increase the quantity supplied from QE to QS, their producer surplus has increased from B plus C to, let's say it increases to areas B plus C plus D plus E plus F. Dramatically greater producer surplus. In addition, their total revenue increases to PF times QS, which is greater than PE times QE. What about workers? Workers within the industry of wheat also benefit because since farmers are increasing the quantity supplied from QS to QE to QS, they can employ more factors of production like labor. Thus, there's an increase in employment within this industry. What about the government? The government is worse off because they're going to have to spend tax revenue on buying the excess demand since they have increased their demand to D2 to buy the excess. They will have to buy the quantity supplied, which is greater than the quantity demanded, at the price of price floor, which would be the sum of areas F, G, H, I, E, and C. That would be the level of spending to buy the excess supply. And that creates an opportunity cost because the government could have spent that money on something else. In terms of allocative efficiency, at QS, marginal cost is greater than marginal benefit. Thus, there's an overallocation of resources to production and consumption of this good. This creates a welfare loss of areas C, E, G, H, and I. F is an additional surplus provided to farmers, so that's not counted as a welfare loss. And C and E we would get anyway in the free market, but the government is spending money to generate it. So the welfare loss of all of that government spending is equal to C plus E plus I plus H plus G. And that's it. If you have any questions, feel free to comment, and don't forget to subscribe and to like. Thank you so much.